People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Always ZinniaWealth.com, ZINNIA Wealth.com. The reason I say that is I hope that as you hear the show, you will go to the website, find out more about Charisse, tool around a little bit. We got a lot of resources there for you. You can see our media page with the podcast, and you can see all the different interviews that Charisse has done. You go to the top navigation bar. You go to education. There's a whole bunch of useful guides you can download. There's a lot. So I hope you do go to the website today, ZinniaWealth.com. We are here to talk about retirement. We are here to talk to Charisse. How are you doing today?
I am fantastic. Had a great grilled cheese casino event. Raised more money for more kids. And the Grilled Cheese Foundation is now part of the Bridgeway School for sixth graders all the way to seniors in high school over here in Ocala, which is a huge thing. So we're going to be doing a big breakfast for the teachers and helping them and engaging them and continuing to do a great job over there and see what we can do to help those kiddos over there. So just exciting, fun times. And you know what? I got to do a big shout out. Thank you. We had some amazing sponsors, a couple that came in last minute. But number one, when it comes to people locally, Fort McCoy Beef, we have Todd Rudiani and RJ Jenkins who stepped up and just, I didn't even ask. They donated to the Grilled Cheese Foundation as one of the sponsors. They didn't really want a sponsorship, but I gave it to them anyways. And I'm just so thankful for that and them believing in what we do here. Angie Lewis from State Farm, we're both on the executive board with the CEP, and she's just an amazing woman who's trying to save the world and help as many people as she can as well. We also have Nick Blazier from Cogent Bank. I'm telling you, he's like a brother from another mother, but just so generous with his time and helping sponsor the event. And then last but certainly not least, our grand champion of sponsors, Market Guard, Randy, which you know very well.
Yes, indeed.
Part of our financial engine. And they stepped up and just said, we really want to help fund your venture. And they did it last year, and they just believe in everything that we do for the kids. And so I was, was in tears with all the sponsors because I never imagined 5 years ago when we got started with the Grilled Cheese Foundation that people would believe in what we do and actually back it up with money and help us, raise even more money for kids. So I just found out we have a few kids that are applying at the Grilled Cheese Foundation, and it's nice that we can fund it and many more kids to come. So I'm in a blissful, joyful moment right now. This has been really incredible. And I'm just so thankful for our community and the people who are believing in what we do here.
And for those of you, if this is the first time you've heard the show, the Grilled Cheese Foundation is the foundation that Charisse has started. And, when we all were coming up and participating in after-school activities, if you're going to play baseball, you needed cleats. You needed different things. If you're going to dance, you needed shoes. If you were going to play...
you needed to pay for your classes.
There you go.
Just to go that get
all
there.
Of that stuff. That's what Charisse has designed this to do. I mean, helping with things like school supplies and backpacks and things like that as well, and helping with college and helping with some scholarships there. So it's all helping get kids on the right track and helping them when they need help. So it's if you want to find out more, go to our website and you can find the Grilled Cheese Foundation there as well. So why don't we dive in here just a little bit? Charisse, this is an interesting time that we've got going here. The market seems to continue to go up. It continues to break new records all the time. But anytime that starts to happen, people go, well, how long is this going to last? And I'm hearing a lot of negativity out there right now. So, for instance, Warren Buffett has this indicator that says, he takes the total value of U.S. stocks and he compares it to GDP. It's all very technical. But right now, that is flashing red. It's saying we're on our way to a pullback. It was flashing red right before the tech wreck of 2000, and they said there's a lot of similarities there right now. Gold has now gone up to $4,000 an ounce, and usually that's when we're going into a recession or people don't have any confidence in the economy, yet the market still continues to go to new highs. Credit card debt is way up. There's so many different things out there that make people nervous. So I wanted to ask you about that. When you sit down and talk to somebody about their risk level and how much money they want to have in the stock market, does that, like a relationship, go up and down, throughout the years that you say, okay, let's pull a little bit back, let's push a little bit in? Or is it more like, this is what I'm comfortable with, Charisse, let's just set it and forget it, and I can live with this? How does that all work?
Oh my gosh. You never set anything and forget it. Never set it and forget it. It's a good way to get divorced from your wife, your husband, and your financial advisor. Okay. So, oh my gosh, all that is so true, Randy. And there's so many people. I have had so many conversations. And Charisse, gold's going up. What do I do? Do I buy gold? Charisse, bonds are going to go up. Should I transition back to bonds? Charisse, it's like real estate. Interest rates can come down. It's going to be a seller's event again. People are going to be able to get into those homes. Sure, it is a lot. And I'm going to tell you guys, I have been doing this for so long that my head is even spinning because it's all nonsensical. The math doesn't add up because market's going up, gold's going up. Okay. Gold's like really going up. Warren Buffett just bought a ton of gold. So when you all hear that, you're like, let's run to gold. So is risk something we should tinker with is the big question.
Right.
And I say it depends on you. It depends on the season of life that you are in. Are you listening to the show and 30? Probably not. Very few 30-year-olds listen to the show, but I will say 40-year-olds do, 50-year-olds do, 60-year-olds do, and 70-year-olds do. And some of my great 80-year-olds, great generation is listening right now. So to all of those different generations and those decades, it depends on where you are at. Because I will get a 70-year-old in my office, and one of them, here's client A, wants every dime of their money in the market. And I beg them to pull back the reins a little bit on some of it. And sometimes that takes a while. Then I have client B, my other 70-year-old, who's like, Charisse, if you lose me a dime, you're fired, right? So it's not just the season of life that you're in, it's how much of your money do you need? So now I want to dial back the reins, and let's say we're 45 years old. And it blows my mind, Randy. I'll get one 45-year-old. So we work with 50 and above, but we have inherited our clients' kiddos, and we take on the kids as just part of our package. And I'll have one 45-year-old that is all in risk. And I'm like, go, gadget, go. I'm like, this is what you should be doing at 45, because especially if they're not retiring until they're 60. Now, if you're retiring at 50, we might change that story a little bit. And then I get one 45-year-old that is like in cash. Mind blowing. And that's because the 45-year-old that had their money in cash, I hear the stories like my parents lost all of their money. Oh. So it's about financial education. Okay. And what did my parents and grandparents go through? Because you hear about the great generation and then the baby boomers, if the baby boomers really failed because the timing wasn't on their side. Let's say you're 45 years old and your parent retired in 1999 and saved $1 million. Well, by 2002, that $1 million 401k was a $500,000 201k, right? And so you watch your parents go through that, and then they retired, and then they nearly had to change the way that they spent in life. They didn't get to enjoy their retirement because they didn't go back to work. And then 2007 crash came to 2009 and lost another 50% if they stayed committed. So it depends on timing and finance and who you know, right? And who's been your leader and what did they go through? So I'm going to keep this short because we're talking about, should you tinker with risk? And I know you all have a different take on this. And I do feel that compliance-wise, everybody should have a little risk in their portfolio. But if you are someone who says, okay, my parents went through this, I'm at this age. I need this much income. Sharice, it's not what I make, it's what I keep that counts. I have a plan for you. So no, you, that individual, should not be tinkering with risk because you're going to make really bad emotional decisions. When you are confronted with market cycles that are up and down, you're not going to be able to handle it. And then you're just not going to be able to live your life because you're so stressed out about it. So your money management style needs to match your heart and your stress level. Bottom line.
Yep. Don't be wandering the halls at night because you're afraid you're going to lose money in the market. That is a red flag.
Yes.
And that means that if you're really nervous about these headlines right now, it is time to see Sharice, and let's get that off the table right now. I don't want you changing your retirement lifestyle because the market is down, or there's the threat of the market going down. Who knows? Nobody's got that crystal ball. Sharice doesn't. I don't. You don't either. And the fact of the matter is, let's get a number that you are happy with. If you put it on a speed limit, are you happy going 25 miles an hour or 30, or are you happy going 50 or 55 or 60? Okay, let's figure out what that is and get that out on the table. What we do is what's called a complimentary retirement consultation. This is going to be one of the big parts of the conversation. How much do you want in that market now and deep into your retirement? Give us a look on the website. You'll see that right away. There's a gold box right there. It says complimentary retirement consultation. What is that? It's exactly what it sounds. It's a no-cost, no-obligation meeting with Sharice to just get to know you and handle questions like this. You can find us online at zinniawealth.com, ZINNIA wealth.com. Click on that gold box. You'll be on the way. Or you can call us 833-368-3680, 833-368-3680, or again, zinniawealth.com. All right, so one of the big headlines out there is, of course, you hear the words Social Security, and then you see the word bankrupt after it, and that's just scary as it can possibly be. Not really true. Social Security is not going bankrupt, but the trust fund, the extra money that they use, is running out. So that means in about 6 or 7 years, that $3,000 a month that you were promised in Social Security might be more like $2,500. You're going to take a hit on that, about a 20% hit. So what is Congress going to do? How are we going to solve this? Well, here's a couple of ideas. A couple of senators, Bill Cassidy of Louisiana and Tim Kaine of Virginia, say what they'd like to do is they'd like to borrow a bunch of money, create a trust fund, invest in equities and other high-yielding assets to fix the shortfall in Social Security. Sharice, that just makes me nervous right away. He's gambling with my money.
That sounds like a sticky finger deal. That's the chicken fingers on sale right there, you guys. Okay, so I get where he's coming from with that because, cash flow arbitrage, right? So we have money. It's costing us 2%. But we're making 4%, right? If that's the thinking and they can show the math on it, maybe so. But then I just worry about where our government has been over the last century and why Social Security is in the position it's in now due to corrosion and
poor management, really. I mean, really, poor management.
Yeah, exactly.
I mean, it really is.
So do we just find ourselves in another bottleneck? So no, I just don't think getting a loan. I mean, we are loaned out. United States, I mean, we are loaned out. And that's just the way we've been, right? Where people are buying our debt. So is that the route we keep going down? And, I don't know. I think the tariff conversation needs to come to the equation and pour in some money from there. But nevertheless, I'm not a fan of that one. No.
So one of the things that you and I have talked about in the past is, this is human nature. People get to 60 years old and they look at their retirement account and they go, oh, it isn't big enough. So what am I going to do? I'm going to take more risk and I'm going to roll the dice right before retirement and hope that the market goes up and it's going to make my retirement account where it needs to be. That's really what they're doing here. And we caution against that all the time. That's not the way to do it.
No, it's not. It's really, there has to be more foresight when it comes to the plan. There needs to be more consistency. It definitely needs to be regulated a little differently. And I don't know if it's private getting involved a little bit more. So I do worry because I have clients that have $3,000, $3,500, and $4,000 in checks. And if they start saying, hey, okay, we're not going to go to this loan thing that they're thinking, but what we're going to do is there's going to be a flat amount you can collect no matter where you're at. It's going to hurt people's income. And if we do nothing, it's still, and there's a 20% reduction, Randy, on Social Security. It's going to hurt people. I mean, credit card debt's already maxed out. There's not a ton of cash flow out there. People are leveraged so highly into the market right now. And one big crash hurts Social Security, hurts people's incomes, hurts the credit card world, because now the credit card's getting paid back. I mean, this is how we end up into a Great Depression, right? And so there's so many signs out there that we need to get really smart people part of this leaderboard, and then they need to share the story. Like, what's the plan? What's the math? Give me the KPIs, people. I mean, Social Security and the government and the Federal Reserve can show us some like real data, like a 10-year plan. If we do this, this is where we stand. But do you notice that we actually don't get that data? Like,
Nobody talks about this because they're scared. Because if you start talking about Social Security and more taxes and things like that,
you're not elected. You don't get elected.
You won't be there very long. You know, you're not going to be in the leadership group.
Could you imagine in my business if I have a 50 or 60-year-old sitting with me and I can't show them what it looks like 30 years from now and give them that written plan?
You get fired.
What kind of confidence are you going to have in me? Especially if I'm just promising you the world, okay, over the next 10 years, your money's going to double, and then it doesn't.
Yeah.
Right? I mean, this is like smoke and mirrors, dog and pony show, right? Let's lasso them in here, and then it just goes upside down. It doesn't ever work. We need a plan. We need a really good, solid plan and some KPIs to go with it.
Well, let's see if this works for you. Okay, here's another one. This is the other one that came out this week. And this is not a politician doing this. This is the American Enterprise Institute. Not familiar with them, but they came out with an idea. And they say no matter what your income, no matter how long you've worked, no matter how much you've put in, they just simply cap Social Security at $2,000 a month for everybody. So Elon Musk, you get $2,000 a month. Randy, you get $2,000 a month. I don't care how much you put. I got to believe you got a lot of people that are getting more than that in their Social Security.
This is why we have Medicaid. Listen, because the reason why America is great, it's self-enterprise. We are building our businesses. We are working for employers. We are growing our salary. We're buying into the system, right? And then if all of a sudden, no matter how hard we work or how much we contribute into FICA taxes and Social Security, and no matter what, we're all at 2,000, where's the deliverable? How are people going to get excited about, oh, I could have been 4,000, but now I'm 2,000, when a lot of retirees just need $4,000 to pay their bills and do a couple of trips in retirement. So it changes the mindset, Randy. It's like, it's not going to work. It's just not going to work. I can deal with like a flat tax or something like that, but not a flat Social Security check, because it changes the way people think and how they grow business or work for an employer. And I think it'll erode what makes America great, and it will change the history of how America works. Yeah, we need to change some stuff, but that's not it.
Yeah, people are going to be going into retirement. If you say we're going to cap this at $2,000 a month, there's a lot of people that depend on Social Security for nearly 80% of their income. Maybe.
Yeah, if that happened in my office, average clients are at least 3,000.
Yeah.
And then now I got to come up with an extra 1,000 a month, 12,000 a year based on our income plan. I mean, I'm pessimistic on our plan anyways. We can make it work. But that means there's less money in that funnel for the legacy and or the long-term care plan or whatever it might be. So, and some people would absolutely derail our entire plan. I will tell you that, because when we are talking about our spending plan in our office, I'll say, hey, let's take a couple extra $1,000 a month for the next 10 years and pull back the reins. And if that was our plan, and all of a sudden we got to take an extra $1,000 for Social Security, it changes the way we spend in retirement. It changes the way we think. And when people are retired, it is your time to not have to think, enjoy your life, take the money that you earned and go blow it, right? But do it prudently with a plan, right? And get the math tied into that, so that if you do want to leave a legacy and you don't want to spend your last dollar and your last breath, you can. But the government might force us to spend our last dollar and our last breath if they don't get their together.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth, and we're talking about Social Security in this segment and a couple of these proposals. One is to borrow a bunch of money, put it in a market, and then hopefully it goes up, and then that's going to shore up Social Security. Not so hot on that one. Another one just recently is cap everybody at $2,000. Maybe it makes the program go further, but it sure might hurt an awful lot of retirees. You know, and Sharice, the other one that I've heard people talk about this all, here's a simple fix. Just raise the Social Security age. Instead of 62, you got to wait till you're 64 before you get Social Security, and your full Social Security age is now going to be 70. And I listen to that and I go, look, I don't care how good healthcare is and what advancements they make, and we're all going to live to 100. Okay, fine. But that, you know what? After you've worked 35 or 40 years, when you get into your 60s, you're burned out. You are ready to retire. And if the government looks at you and says, well, you're not going to get your money till you're 70, there's still a whole bunch of people that are going to retire between 62 and 65.
I can solve that problem.
Okay.
The entire country turns into a 4-day work week, and then you can keep working till you're 65, 70.
And there it is.
And there it is. But honestly, I mean, I'm always challenging the status quo, Randy. You know that about me. And here's the deal. People are living longer. It is on the rise. People will not be able to retire at 50 or 55 or 60 like we once have before because they haven't saved enough money. And if life expectancy is on the horizon, because we all want to live longer, right? But we want to do it healthy. And so I think there is going to be a big change there, and people need to start thinking about that part. So, you know, some things to talk about on the horizon, Randy.
It's such an important part of the retirement planning conversation. And it's not just Social Security. That's going to be a part of your income plan, the money that's coming in. And then there's got to be more. I mean, that is really the crux of it. And we talk about this all the time. People really can't live on Social Security alone. There's got to be something else. How does your 401k become a paycheck in retirement? How does your pension become a paycheck? How does everything that you've done for retirement to save, the property that you own, whatever you've done, how does it become a paycheck? And I mean, that's the crux of the matter here, is building that income check for you in retirement. And that's really what it is to sit down with Sharice and go through the process. We have a complimentary retirement consultation. Big title for, let's have a meeting about your retirement. Let's sit down and actually put the pencil to paper and say, you've saved this here and this here. You've got these bills. You haven't quite paid off your mortgage yet. Your cars are paid off. All these different things. Let's look at that really under the microscope and figure out what your retirement's going to be. Then we can start taking steps forward. 833-368-3680. 833-368-3680, or use our website, which is zinniawealth.com, ZINNIA wealth.com. Click on that gold box that says complimentary retirement consultation. So every neighborhood, there's one house, at least one house, that just goes crazy on Halloween. And this comedian kind of brought it all out to the forefront here. His name is Eric D'Alessandro, and he's made some interesting observations in his neighborhood.
When I was a kid, for Halloween, you'd put like a decal of a witch on your window, or you'd use the fun jack-o'-lantern bags for your leaves. Now it seems like every house that I pass, they got Warner Brothers budget. It's like they rented props from the Beetlejuice set. Everyone's complaining about inflation and the price of eggs, but Home Depot can't keep these 40-foot skeletons on the shelves. Where are people even getting this stuff? A vintage hearse? Does Carvana even sell that? And most of the decorations that I see can't fit in people's attics or basements or garages. So they're literally just renting storage units for Frankenstein?
Oh my gosh. That is so true and so funny.
I love it. I love it.
That is fantastic.
And I mean, when it comes to Christmas stuff, I mean, I got it stuffed in closets. I got it underneath the stairs. I got it all. I don't think I have room for the 45-foot skeleton. I really don't.
I had to rent a storage unit for my Christmas stuff. It's under Zinnia's name.
You are the one, Sharice.
I am the one. But I have only 2 boxes of Halloween stuff, and we haven't put it up over the last couple of years because my kids are just like, Mom, it's kind of goblin-y. And so my daughter's like, I don't think we should do Halloween the way we used to. And I grew up with Halloween, and she goes to the Christian school, and she loves her youth group. And so they don't do it. So therefore we don't do it. Mm-hmm. But my son's like, Mom, what's wrong with a little scary? And he's like, I understand what Ella's saying, but I still want to decorate. I'm like, okay, let's go to the Home Depot and look for stuff. And you know what? He picked that 20-foot skeleton. I went, you said that you're agreeing with your sister, but you still want to do a a little decoration. This is, I don't think I want the Grim Reaper in my yard. Like, what does that say about us? I don't know that. I mean, I didn't even watch Halloween and those scary movies, the movie Halloween. Like, I don't do scary movies. And
I
I'm
don't
just
either.
like, son, you are so not like me. But anyways, I get the vibe. It's fun.
We are over the top sometimes with our Halloween stuff. That is true. All right, let's use that term, over the top. I got to believe, when we do this show, we are introducing you to Charisse and saying, hey, you may not be able to do retirement planning yourself. Let's get a little help. This is how Charisse does it. It might be a good fit. And there are people that come to you in all different manners of preparation. Couples who come in and they never even talked about it. Or people who come in and they've saved really well. They have no idea what to do next. Or there's the person who comes in there with spreadsheets and said, okay, I got, the market got 25% last year. I got 26.6 and I did this. And they come in and they got 17 mutual funds and a whole bunch of stocks. And it's, wow, look at all of this. Are there people that you kind of have to say you're a little over the top with your retirement planning and maybe we need to pare this back a little bit? You know what? I will say, in the nicest way possible, that most people that come into my office, it's a scary scenario. Some people, why it's scary, number one, they didn't save enough. The other scary is they're spending too much while they're working. They're about to retire and now they want to spend the same amount, and that's not always possible. The third scary is you're sitting in cash and you're doing nothing. Like, that's the worst thing we could be doing. And the fourth scary is you're too smart for your own good. So out. And if you're not willing to listen, but most people who do come in my office and they bring that spreadsheet, they're like, yeah, I did 26, but the market did 25. I pat them in the back. I'm like, well, why are you here then? I mean, I straight up, why are you here? Well, my wife doesn't understand this stuff. I was like, oh, okay. Yeah. So the scary thing for those people and all people, and we've really changed the conversation over the years, and it started during COVID, Randy, but more and more people come and see us because their spouses don't follow the stuff and they want their spouses to get more involved. They want their spouses to like somebody. They want that somebody to respect the spouse, talk to them directly, help cater and hold their hand a little bit more. So if we pare it down a little bit in your investments, it's not just about the investment. It's about the who, the how, what are we going to do next? And what is like you said, Randy, the overall purpose of your money? What is the purpose of our money? Mm-hmm. Is it to spend every dime before we pass away? If we live to age 85, is it to spend less and take all that hard work and just pass it on to the kids? Is it just to make sure you're not standing at that front door of your kid's house with your hat in your hand saying, I've spent all my money and now I need you guys to take care of me because I don't have money for long-term care? Like, what is the why behind what you've done all these years and before you retire? And what do you want that money to do for you? That's like for one of the first questions within the first half hour, I ask everyone, like, what do you want your money to do for you? Because once I understand that, and once our team and our other advisors understand what is the why behind what you've done for the last 30 to 40 years, what do you want to do in retirement? That solves half of the problem in the equation. And some people come in and they don't know, Randy. They come in. I mean, it's just like business owners. Like, what is your why? Like, or just mindset, trying to figure out that why. And some people just don't have it figured out. So when you come in and see us, we help you figure out the why and the what and then how and then who does it and puts it together for you, right? And so there's all those moving parts. And I would seriously consider making sure you are working with somebody who understands your why and what you want to do and your purpose of your money. Because like you said, Randy, you have somebody come in who's a high flyer that has 17 mutual funds. So what? And maybe you have this best 17 mutual funds, but what about all the other stuff? Are you leaving all that money to your beneficiaries taxable? That mutual fund not necessarily doing any better than the exchange traded fund that could have saved you 1%, right? Mm-hmm. That mutual fund, if you happen to die and the market crashed and it takes 5 years to recover, those assets are being passed on before that 5-year recovery of the stock market. And your kids and the people who are inheriting your money aren't getting all your money. And trust me, they've already cashed it out and bought that red Ferrari. You haven't. I've seen it. It's awful. And so that why also has to do is, do we get a trust? Do we tighten up the bolts here? Knowing that money could go very fast, so that there's some rules saying, no, you can't touch this money for 10 years if the second spouse passes, and in case those types of things happen. So there's so many things to think about
and what the purpose of the money is for. But number one, inflation's on the rise, right? Even though interest rates are going down, we want to make sure your income is always there when the market goes down. We want to have a reasonable average rate of return, which means we want a mixed basket of assets and be very diversified. The 60-40 is not diversified, by the way, in your portfolios. You need more stuff, in my opinion. And you want to be able to keep up with inflation. And you don't want to rack up your credit card debt because inflation's so high. So how do we beat the inflation conversation? So that's a big one. And then we talk about all the other things. If you're a money manager and you're all about returns, what about the Social Security check? What are you going to do? When are you going to collect it? What about your Medicare? Like, do we get the supplement, the Advantage plan? Do we get an HMO? Do we get a PPO? Do I pay a premium? Do I not pay a premium? Do I self-pay? Like, those are all those questions we actually answer for you and help you. We walk through that retirement journey. And then the one thing that people are so scared about, Randy, they're petrified. They think about it. They don't sleep at night sometimes because it's a trigger in their mind. What am I going to do if I go into a nursing home? Mm-hmm. And nobody's talking about it. They come in and I have to peel away that onion and be like, where do you want to be? Do you want to be staying in your home? Do you want to be in a nursing home? Do we even have the money in the future based on your spending now? Do we need to buy life insurance to cover, if you spend all your assets, to leave it for the surviving spouse based on your scenario? So there's so many questions there. So that to me is very scary. And I know a lot of people out there are worried about it, but yet they don't talk about it. It's like this, I'm going to stick my head in the sand and just pretend it's not going to be there because it's not going to happen to me, but it happens, right? So to take the scary off the retirement checklist, let's go through that retirement checklist. Let's make sure we dial in, we check each thing off so that retirement isn't so scary.
Yeah, I think that many times we make this a lot more complicated than what we need it to be. And I think also that people are creatures of habit, Charisse. And when somebody comes to you and they've got all these papers and they've got literally their own portfolio and they've been tinkering and they just kind of love that. And that's fine. There's nothing wrong with that. But, many people will come in and they've had 3 or 4 different jobs. They've got 3 or 4 different 401ks. And you take a look at that and you say, okay, let's look at company number A that you worked at here. And it looks like you've got an S&P 500 mutual fund and you've got a bond fund and a target date fund. And then you say, well, what's in company B? Mm-hmm. Same thing. And what's in company C?
The same thing.
Looks like you did the same thing there because that's all you needed to do. And then you have this thing called overlapping. And that puts you at risk, too, because if one thing goes down, you've got all that one thing and you're going down. You don't have any yin and yang in your portfolio.
Yeah, let me add context to that, Randy. It's called your correlation matrix. Now let's really get confusing. I'm about to geek out on you all. Your correlation matrix is an absolute must trigger that you look at when you're looking at your reports. And a correlation matrix is this. Let me give you the simplest form because I am the physician of finance. Okay. You go into your doctor's office and you complain that you're not feeling well. I feel like I gained a little bit of weight. Is it my thyroid? Giving yourself all these other excuses. He's like, no, it's not. What did you eat for dinner last night? Oh, you just had a steak and a glass of wine? Okay. What did you have for breakfast? Oh, you had bacon? Okay. So here's the plate of food that you need to start eating to fix some of these problems. They're going to say, have maybe a little steak. And then tomorrow, don't have steak, have some chicken. And the day after, maybe have some fish. And when you have that plate of food, just don't eat that steak. Why don't you put a little color in it? Why don't you have a little broccoli? All right, for the fiber and nutrition. Maybe have a little sweet potato, right? And then mix the flavor up on the plate and proportionalize yourself, right? And that's what your correlation matrix is. We don't want all sweet potato. We don't want all steak. We don't want all broccoli. We want a mixed caliber of investments in your portfolio so that when the market goes down, you potentially can make some money. And when the market goes up, you make money. You don't want all things doing the same thing because that's not a healthy recipe for success, especially in retirement and you're living on your money.
My financial advisor is telling me I have to eat broccoli. I hate
broccolini.
this.
We should talk about broccolini. I had that for the first time in a long time. Yeah.
You and your broccoli. You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com, ZINNIA wealth.com. There is a gold box there. It says complimentary retirement consultation. This is a meeting. It's a meeting about your retirement. It's a meeting to bring your questions to. It's a meeting to bring your concerns to. And maybe you feel like you're really ready for retirement. You've been working really hard on this, and you want to get that opinion. Charisse, can I get the green light to retire? Well, let's have that meeting. 833-368-3680. 833-368-3680, or online, it's zinniawealth.com, Zinnia wealth.com, and click on that button that says complimentary retirement consultation. You'll be on your way. All right. Recently, we did a story about the popularity of dividend-paying stocks. It was interesting because as baby boomers get into retirement, annuities have been selling at record numbers. And then when the interest rates went way up, CDs were selling at record numbers, obviously, because the interest rate was up. You're getting more for your money. Now, dividend-paying stocks are doing very, very well. Well, it's interesting here. The Mag 7, which we hear about all the time, all those tech stocks, some of them have dividends, some don't. This article says, watch out for the suspicious 8. And these are companies that have dividends, but their dividends are so high that it's a little bit of suspiciousness going on here. And the names here, Charisse, UPS, ConAgra, Kraft, Pfizer, Verizon. These are really well-known companies, and they have dividends at 6 and 7 and 8 and even 10%. You talked about that a couple of weeks ago and said this is a warning sign. Does this bug you? I mean, are you using some of these, or have you used some of these?
Yeah. So for first-time listeners, and if you're not following the Mag 7, this to give you context, that's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, right? This is where a lot of people hang their hat and just it's growth, growth, growth. But there's times where some of those aren't growing, but then there's times where there's sectors like the change and or large cap versus small cap or mid cap growth does better than others. And right now there's a go-to for large cap dividend stocks, right? But you also have to look at the buyer beware behind it. So just because your neighbor says, hey, I am buying Verizon because there's a 7% dividend and I have the cell phone and they're never going anywhere, does that mean you go buy it, right? And full disclosure, I'm going to pick on 3 companies. I'm going to pick on Verizon, Kimberly-Clark, and Procter & Gamble. All companies you guys are like, oh, she's going to pick on those 3? Yeah, I'm going to pick on them because I've been following them for years and they have been in my portfolio, but I've really just taken them out because they aggravate the tar out of me and for reasons that we're talking about, this dividend. So when you're talking about a dividend, you're either got a company that does not pay a dividend and you're going to have, sky's the limits growth, and or you're going to have a company that pays a dividend and we don't have as much growth. So for example, Verizon, if you look at the charts, especially the last 5 years, it has paid between a 5 to 8% dividend. Well, that tells you dividends are not guaranteed. So if you bought that dividend at a time period where it was paying 7.5% and all of a sudden now it's 4.5 or 5%, and you were counting on that money for income, you have to start thinking differently because now you got to go to another source to get that income. And or you're selling that dividend stock that went from 7% to 5% dividend to go buy one of these other stocks that are paying a 7% dividend. But how much of a loss do you have to take to sell Verizon at the wrong time to go hop and jump and skip on over to another dividend stock, right? So I've seen so many people do this over time. So number 1, dividend stocks are not guaranteed. Number 2, I do like dividend stocks, and we do have a dividend stock portfolio that does quarterly trading, right? When something's not paying what we want it, we get out of it, we go into something better, but without taking a loss. There can be a trade-off sometimes. For example, Kimberly-Clark, everybody's got to blow their nose and, everybody has babies and you guys know the rest of the story.
Yes, we
all
do.
need tissue for something, right? Kimberly-Clark, same thing. I just officially said a while back, I am done with Kimberly. I'm out of here because it doesn't pay a high enough dividend, in my opinion. If it fluctuates between 2.2 and 4.2% and the stock is still sideways for the last 5 years, that for me, my clients are like, Charisse, okay, so we get this dividend, but the growth isn't there and it goes up and down and it's sideways for 5 years. Should we really have it? Even though that dividend gets reinvested back into another Kimberly-Clark stock, for example, buys another stock, but at a 2.5% dividend, it might take a while to buy that stock, right?
So what you're saying, let me stop you just a second here. So for instance, if the stock were at $40 a share and you're getting a 4% dividend, and then the stock goes down to $20 a share and you get reinvested, you're now buying a stock at a lower price.
Which I'm fine with. And I like those ebbs and flows because now you're buying another share of that stock that pays you another dividend.
Okay.
Right. So it's kind of, in my opinion, it's a slow and steady way to invest. But for the people who need it for income that are not reinvesting it, it's trouble. It's troubling. Do you know how many people that used to come to me and it's like, oh, my advisor has me on these dividend stocks and my income has gone down $3,000 quarterly. For anybody's income to go down $3,000 quarterly because they didn't have a diversified portfolio, and now they got to figure out they've got to sell the stock that may be at a loss. You are changing the way you've always invested. Financial conventional wisdom: never sell when the market's down or the stock's down. But yet you got a forced hand because the dividend's not paying you the income you need, right? So you have to think through these things. And I'm a fan of having some of these things. But when it comes to these dividend stocks, which I think is the suspicious 8 that you were questioning, Randy, is that they're paying a high dividend. A good dividend company on average pays between 3.5% and 4.5%. Those companies that do that on average have more consistency on their dividend. Therefore, we don't see it change. So if a client wants income, I'm going to go to the companies that consistently pay that 3.5%, 4.5%, because I know those checks are always going to arrive if they need it for income.
So I hear this term aristocrat dividend stocks. Is that what you're talking about here? Ones that are consistent and have been over the years?
Yeah. So that's a great one, right? Which is still not perfect, but we want consistency. And when you buy, for example, Verizon and the dividends at 7%, you have to ask yourself, well, why are they paying a 7% when AT&T is only paying 4.5%, right?
Or if it's a high flying tech stock, maybe they have a 10% dividend, and then you kind of go, these people just need money to keep going.
It's trouble's knocking.
Yeah,
Trouble's knocking.
Yeah.
And then therefore you can see that the stock over the last 5 years hasn't developed. And neither has their customer service. Another story.
Yeah.
So
there's a story behind that story here. I'll get that one off the air, folks.
Yeah. Kimberly just disappointed me during COVID because there wasn't enough toilet paper around. So there's another story. I got a story for a story. I've been around long enough. But let's talk about the last story, Procter and Gamble. You guys are like, she's going to pick on like this glorious staple of our world, Procter and Gamble. Yeah, I'm going to pick on you, Procter and Gamble.
Laundry soap. Come on.
I love my laundry soap, and I love all the products that they make. But come on now. Here's the deal. Here we go. You ready? If it's paying a 2.5% dividend, for example, and the stock 5 years ago was $149, and 5 years later it's $141, Houston, I feel like something's upside down and backwards here, right? And over the last 5 years, it did jump up to 179, and all of you are like, yeah, it did amazing. And for a very short amount of time, then it came right back where it's supposed to be, I guess, in the 140s. I'm telling you, when you're looking at your portfolios and you're with your advisors and you have the wrong stock set up in your portfolio and you're wondering why the market's going up, but yet your accounts are going down, it's because the type of funds that you're invested in. So you got to look at the history of this fund and its capability. And lo and behold, if you look at the Procter & Gamble's and these Kimberly-Clarks, they have these run-ups. But since 2019, they've never been able to adjust and arrive back into this game because things are changing since COVID. And with change, you have to change, and your investment strategy have to change. And you can't just go buy Colgate anymore and Procter & Gamble stocks. And you got to be a little bit more diversified.
The idea that you're going to sit down and buy 2 stocks and that's going to, power your retirement is probably not going to be what you're going to need.
I don't want you stroking out on a bad portfolio in my office.
Let's just have purpose for our money. That's what we want to do. This is going to do this. This is going to do this. And this is going to power my retirement. Let's have that kind of a plan for you. And we would love to have that conversation and start down that road. 833-368-3680 is our number, 833-368-3680, or use our website, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. That's just a free meeting. Let's sit down and get your concerns out on the table. Again, zinniawealth.com. Sharice, that is all the time we have for today. I'll give you the last word.
All right, you all. Thanks for tuning in on this beautiful weekend, and hit the rewind button. This has been an interesting hour, Randy. So if you are interested in some controversy, I would hit the rewind button on podcast, on YouTube, outlet, Spotify, iTunes, you name it. We're there for you. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.